Welcome to today's stream. And today will be a different kind of stream because lately the streams have been about doing an analysis every single day, analyzing the Forex and the crypto markets. And today I thought let's explain how I trade. So I will explain more about how I place an entry, how you can place an entry yourself. And I'm trying to explain it as easily as I can so that anybody can do it in this way, okay? And if eventually you'd like me to analyze anything, let me know in the comments, and I will do it anyway. So let's start with the explanation. So how I place my entries is completely based on supply and demand. So to understand it, I will explain supply and demand first. Otherwise, you will not understand what I'm talking about. So let's start with a demand zone. Okay. So let's say your chart looks like this. And it's just a simplified version of a chart, obviously, but you need to simplify it to understand it. So let's say you see this. Well, what is a demand zone? A demand zone is mostly the starting point of a rapid price movement. So this fast moving price action is what we call a rapid price movement. That's this part. You can see that it's a rapid price movement because compared to this move, for example, or this move, it's a relatively fast movement. It has a lot of volume, it's moving really fast, and that indicates that there has been a lot of buying pressure. So to easily find a demand zone in which there's a lot of buying pressure and a lot of demand, you simply look for a rapid price movement going up, and then you look at the starting point of that rapid price movement, which is this zone. So how I draw in these kind of zones, I will explain it a little bit further. Now what you need to understand is you're going to look for these kind of high volume rapid price movements and look at the starting point of those movements. That's it. So, and that's the demand zone. So why is there so much demand at this point? Well, there's a lot of demand here because this rapid price movement was created by a lot of buying pressure. So there has been a lot of buying pressure in this area. Otherwise, it would not move up so rapidly. So if you see anything like this, you already know there's a lot of buying pressure at this area, which means that ultimately there's still a lot of demand in this zone. So people are generally looking to buy in these kind of areas. And that's also where, at least that's how I see it that way. So I see it like the banks and the bigger parties that are really pushing the markets. They are at these zones. They are placing their entries at these kind of zones. Because here's the most liquidity, here's the most buying pressure. Okay, Justin asks if it has to be confirmed again or can you just tell it by happening once. So I will show you an example. Because if it happens once, then it's enough. Then it's already a demand zone. So let's say you have this movement, which is clearly a rapid price movement in my opinion. So you see this kind of messy price action and then you see a really quick movement upwards. So now you found your rapid price movement. And then I'm gonna explain how to draw in the zone later, but it's just about the idea right now. So let's say you pick this candle, for example. This is your demand zone, and this is where a lot of buying pressure is. So you don't need to have more rapid price movements created in this same zone. Although you very often see this, and you can see this as well right now. You see that it formed a lot of resistance here as well. So it does happen that when you see multiple rapid price movements at one area, then it's very likely to be a really strong zone. However, it's not necessary. So this is, for example, a demand zone. You could have placed your entry here. You would have had to place your stop loss wide enough, otherwise you would be stopped out, but this was a possible entry. And this is on the 1 hour, by the way. So this is kind of like in between day trading and swing trading. So before I explain how I draw in the zones, another example here. So I see this movement downwards, for example. It's a really long candle, so that means it's a rapid price movement. This one as well, in my opinion. So here is a zone. That's what we call a supply zone, because that's the opposite of a demand zone. And here you have another supply zone as well, which turned into a really good short trade, like you can see. And this is actually the example of the reel that I just posted on Instagram, by the way. Okay, so hopefully this makes a little bit of sense. Now the question is, okay, if you have your rapid price movement like this, for example, and by the way, there are many times there are multiple rapid price movements, because you can see this as a RPM. I like to call them RPMs. So you can see this as a RPM, and you can see this as one as well, and even this as well. So there are so many RPMs to be found, and you could create your demand zone here and here, for example, maybe even here. So you will see a lot of demand zones, supply zones. So the question is, how do you draw them in, and how do you filter out which ones are good enough for an entry? Well, I do this by, so if I see this RPM, I do this by drawing in the zone based on one single candle. So let's say we're looking at the example we just had. Yeah, this one. So let's see, you have this example. So what I then do, I draw in the zone based on one candle at the start of the rapid price movement, which is this candle. So you always draw it in by using one candle. And I already know what people think. How do you decide which candle? Yeah, that's what I'm going to cover now. Because that's for most people, that's the hardest thing about trading using supply and demand. Deciding which candle you need to draw in your zone. So, for example, what other people could do is they could say, okay, I'm going to use this candle, or I'm going to use this candle. Why I select this candle is a whole different story that I will cover now. And if it's like going too fast, you can rewatch this stream, and I will make videos about it as well. Because I'm streaming way too much, I need to make more videos instead of streaming. Let's say you have this movement again. Oh. And let's say there's a candle. No, never mind. Let's do it like this. Okay. So what you're looking for in your demand zone is what's called an imbalance. And this is a really clear example of an imbalance. And some people like to call it a fair value gap. So if you hear the term fair value gap, it's the same thing as an imbalance. I like the word imbalance. It's shorter, it's easier. What it basically is it's the space between your first candle, so the candle creating the rapid price movement, aka the demand or supply zone. So let's say this is your first candle. It's the space between the first and the third candle. So let's say this is your first candle and this is the third candle. And this is the second candle, obviously. So you're looking for the space between the first and the second. Or the third, I mean, yeah, the third. So between the first and the third candle. And as you can see here, you see that there's a space between these two candles. And that's what you call the imbalance. So there has to be a space between the first and the third candle. And if there is not an imbalance like this, so let's say you pick, this one. So let's say you say, okay, I'm going to select this as my first candle. This is my third candle. Well, there's no imbalance because you see this wick already. So there's no imbalance open. And there needs to be an imbalance between the first and the third candle. Otherwise, the price won't react or respond to that demand or supply zone well enough. So it's really important, in my opinion. An imbalance or a fair value gap, as you would like to call it, it's really important. And if you don't see it in your supply or demand zone, then it's not a good entry. So another example, for example, would be, why am I saying 2 times example? I don't know. This is the first candle. This is the third candle. So I'm drawing in the zone based on this candle, because if I select this one, so this candle, then there's no imbalance, because there's no imbalance from this candle. So you need to draw in the zone on one candle where there's an imbalance. And here it's a very small imbalance, but you can see this. If this is the first candle, that's your zone. And this is your third candle, there's still an imbalance. And that's what that's needed for a supply or demand zone. Hopefully this makes sense. If it doesn't, you can rewatch it again, because yeah, for me it's pretty easy. But if you're not familiar with the terminologies, then I understand it could all be like new to you or not make sense. But what it comes down to is you're looking for those rapid price movements again. Then you're looking at the start of the movement and just selecting one candle. That's it. And then the extra confirmation that you're looking for is that there's an imbalance. So if I have to draw them like this, so step 1 is find a RPM. Select one candle at the start of the RPM. And then confirm if there is an imbalance. And if there is no imbalance, then don't even draw in the zone, because then it's not a strong demand or supply zone. All right, and again, I'm kind of randomly making this explanation in this stream, because there hasn't happened a lot since yesterday in the charts that I'm looking at. So yeah, I can do an analysis every single day, but I thought this is way more interesting maybe for most people. I will make a lot of videos about these kind of topics. I will actually put a whole video course on YouTube as well, completely for free. And it's just a course that I used to sell for thousands of dollars. Now I will put it on there for free, because I'm not trying to sell a course anymore. And I have to recreate the videos, by the way, because it was all in Dutch. So now it has to be in English. I will show some examples. So this is the last thing I will do. It's a short stream, but I will show some examples of very good supply and demand zones with an imbalance. So this one, for example, so you see this movement downwards, then you see this candle, because there's an imbalance from this candle. If you take this as your first candle, this is the third candle, there's an imbalance here. And that's why the market responded so well to this price point, because there's an imbalance. If there would not have been an imbalance, it wouldn't have done this. Another example is this. Let's see. This is not really a big rapid price movement, but as you can see, it works in smaller movements as well. But the stronger the movement has been, so the more volume, the more buying or selling pressure. So it's more likely to push the market up or down. So you can find these kind of entries, these kind of demand and supply zones, but they're not really strong. As you can see, it responded to it, but then it just went through it. Didn't turn into a great trade. Yeah, this one as well. So there's an imbalance at this demand zone as well, as you can see. And it turned into a really good trade. This is kind of the typical SMC trade that people talk about with like those SMC traders, they always want to have a risk reward of like 10 or 20. That's completely insane. And it's not even, you cannot consistently have trades that have a risk reward of 10. But they will figure that out very soon. All right, so let's wrap it up. This was the stream. Rewatch it if you want to see it again. I will make videos about this. And thank you for watching the stream. And I will see you tomorrow. So bye.